Welcome back, everybody, to another Tips for Mortgage video series. My name is Mike Parkinson, mortgage broker with Dominion Lending Centers in Kamloops, British Columbia, joined by my cousin Jaden Bax in Crossfield, Alberta with Avenue Financial. Jaden, we have some stuff to talk about today. Hey, buddy.
It has been a busy couple of days. We ended last week with, the Fed talking about, either, 75 bips to 100 basis points up for the rest of the year. Canada likely was going to have to follow suit because we can't have too much of a spread with the American economy because of the way that it affects exchange rate and things like that. And then big news hit. So why don't you tell us a little bit about what happened, Mike?
Well, there's a banking crisis that's going on. It started with Silicon Valley Bank in California. Which we kind of heard the grumblings going on in the last little while, and then the crap hit the fan there on Friday, and then over the weekend, and a lot of depositors thought they were going to lose a bunch of money, but in the end, the government's doing, they don't call it a bailout, but it's a bailout. So there's a lot of things happening there. And then, another major bank in the world, Credit Suisse, is having some serious issues. So there's a lot of cracks happening right now. And it's since that's happened, things have changed drastically with predictions, and it's changing by the day, by the hour. Predictions, bond yields have tanked. The prior to that, the 2-year tenure was crazy inverted. Now the 2-year is almost back down to where the 10 years, which means that a recession is imminent. It's starting.
Yep.
So there's all kinds of things happening. I'm already starting to see some 3 and 5-year fixed dropping today a little bit. I think they're going to come down further. What is our 5-year? Do you know what the 5-year bond yield is? What is it, 2.8 or something?
Yeah, something like that. We're seeing 4.79 right now on the 5-year fixed, right?
Yeah, and you got to be real careful that people are like, oh my God, 4.79, awesome, right? But you got to know what you're getting into. Does that mean that rates could be much lower here in the next 6 months? Absolutely. And then that 5-year 4.79 is not looking so hot, right? So things we're going to talk about today, strategies, where we think things are heading, kind of what's going on out there. And, the U.S., you and I just discussed, the U.S. was supposed to be talking about a rate increase. Hey, Jaden, and now what's happening?
Well, that's right. And so they're talking like this next one, it was going to be 50 bips at least. They really inflation. They had to kill inflation. But we've been talking about this on a rate update for weeks and weeks in a row. And this is your mantra, Mike. You're going to keep doing it until something is broken, until they break something. Well, they've broken something. And what happens when you get the kind of situation with Silicon Valley Bank is that consumer confidence in banks in general goes way down. What happens when that happens is people start taking their money out of the bank, don't they? And so
Yeah.
all of a sudden we have liquidity issues. You're going to see a heck of a tightening on lending through 2023. It's going to be tougher to get just kind of regular lending for commercial lending and things like that. And these bankers who we know that Silicon Valley Bank wasn't the only one to buy a bunch of 10-year bonds trying to maximize their yields with this high interest rates, right? Like they weren't the only ones taking short-term money and putting it into long-term, trying to make some money off of the cash they had. We know there's going to be a ton of other regional banks in the United States. Of course, the government is going to do everything to avoid a run on banks if they can. But we're seeing, like Mike said, we're seeing the start of a recession now. These are the cracks and the breaks that happen right before a recession and right before interest rates start to go down. So if you're talking to a broker or a bank today and they're talking about, it's great news, we have these great offers on 3-year fix and 5-year fix, the bond has gone down. Let me tell you something. The bond market has gone down significantly more than the fixed rates have gone down. And that's because the banks are pricing in a little bit of risk still. They don't know what's going to happen with this bond market over the next, let's say, 2 weeks to 6 months. They have no idea. And so they have a big spread on what the actual bond rate is and what they're much, much bigger than what they usually would to set their fixed rates to. And so it's really, really, really interesting that there's still people out there selling a 3 and a 5-year fix. And absolutely, if that's your comfort level and you're going, hallelujah, 5-year fix is down to 4.74. I've been in this house for 15 years, and I'm going to be here for another 30. I have a comfortable life, and I just want to know what my mortgage payment is going to be every month. And you're renewing now, yeah, take advantage, get that 5-year fixed. But if you're not that one in a million person, not only are you going to be paying higher, very likely higher interest rates than the vast majority of everybody else for the next 5 years, if you sell that house for whatever reason, you are going to get hit with a monster penalty if rates go down the way that we think they will, won't you, Mike? Like, it's incredible.
Yeah, you got to be real careful with what you're. Again, we've talked about this, and Jade and I don't have a crystal ball. We don't know where rates are going to be in, next week, 6 months, a year, 2 years from now. We're just telling you what we think and where things should be heading based on where things are at right now, because things are not great. And we've talked about this lag effect for, I don't know, the last, Jay, 6 months. The lag effect of these high interest rate increases over the last year. They're just starting to come into the economy now. And that's with the shorter rate hikes. Like, can you imagine, give it a bit more time with these massive hikes that they've done over the last 6 months, that, if things are already having trouble now, like, just wait and see, right? Like, and it's not just the banks. There's corporate debt coming up for renewal.
Yep.
There's junk bonds, like trillions of dollars in junk bonds with all kinds of spin-offs, derivatives, which means all kinds of investors that have invested in it that have impact all kinds of things. And we're just trying to tell you what we've been learning from many financial analysts over the time, and the numbers that you get from the government. There's, you can't, they're not going to be 100% accurate or really that accurate in the end, right? So we're just trying to tell you what's happening. Yes, there's inflation. You and I know that. Everything we buy costs, grocery store stuff costs a lot of money, or getting your vehicle fixed, or, it seems like everywhere you turn, it's money, money, money. Inflation's here. But I think there's a bigger a bone to pick for the government, and they got to be real careful that they can't let the financial economy fall apart, right? So I think inflation is going to take a back seat to what's going on here. I don't know what your thoughts are on that, Jay.
No, absolutely. So this week is the first time I've heard kind of in a more widespread way economists using the word deflation,
Yeah.
talking about pricing coming down in a meaningful way. And of course, that's great for everybody. All of a sudden, gas is affordable and groceries are affordable, and everything else. But also, there's a huge portion of the population that's laid off, and that's why that all of those things are affordable, right? Because there's not a consumer out there to buy it, right? So, really, when we look at things, Mike and I have both over the last, let's say, between 6 and 8 months, have been strongly on the 1 or 2 year fix with a 3-year fixed max, maybe, and then the variable on the other side. Been very, very strongly in that camp. I think we continue to be there, but I'm even pushing more now. If you are renewing in the next 6 weeks, variable, I think, is absolutely the way to go. The market, and the market isn't always accurate. The market has seen a lot of ups and downs over the last year or two, but the market is pricing in that we could see as much as 1% off of prime by the end of 2023. So there's some upside to taking that bet. We just really think if you are considering right now locking into a 5-year fixed, and your either your banker, your broker, or your whoever you're working with is touting just how crazy good of a rate this is at that time, please call us. Call Mike in BC, me in Alberta. If you're anywhere in Canada, we're going to pick up the phone anyway. And we have the ability to do mortgages basically anywhere in Canada, probably mostly outside of Quebec, but we can access those things for you. But we want to chat, because that's that 5-year fixed, your grandfather's 5-year fixed. That's probably not the play right now in this market, especially with the way things are changing.
No, and we want to just, again, like Jaden mentioned earlier, it's your call, right? If you're comfortable with that. Our job is to give you all the options available, what we can and can't do for you, kind of explain the pros and cons of every term, of every product, and the ramifications, the possible penalties to get out of them, the portability of each. Like, there's way more to a mortgage than just the rate and the term and everything, right? It's all about a package that goes for your financial plan. So basically, we're just here to give you our opinions, and we think that rates are definitely going to be coming down in the near future. Again, that's just the camp we're in. But speaking of that, the U.S. Is announcing next Wednesday what's happening with their rates, and there's a good chance they may go up a quarter if nothing financially disastrous happens in the next week or so, because they pretty much have to. They're kind of behind an 8 ball. It's a tough. It doesn't really matter at this point whether they pause or go up a quarter point. They're definitely not going up a half a point like they thought. That's that's where we're at there. So there's a lot of things going on, a lot of things we're going to keep you updated on. But like Jay said, if you got any questions, just touch base with us and know what you're getting into, right? That's the number one thing. Know what you're getting into, because that great rate today could cost you a lot more money down the road. So if you got any questions anytime, reach out to us. Thanks, Jay.
Thanks.
We'll chat again. We'll see how things are going. We may need to do another update in a couple days or early next week, but we'll keep you guys posted.
For sure. And I guess just the last thing, with everything going on with the banks, people are worried about their banks in Canada. Strong opinion of everybody. And we have 6 major banks that are well diversified. Probably don't have to worry about your deposits in your banks. We're just talking mortgages today. So if you want to talk mortgages, give us a call.
All right. See you guys.
Okay. Thanks.